All right. Welcome again, everyone. Thank you for joining us. I want to, say thanks again, for joining us for our Transformation Thursday. Um, this is my first time doing Transformation Thursday, but I wanted to share my agenda really quickly prior to showing what um, our speaker is going to be showing. And that way you guys know what the process is and what direction we're going to be moving in today. Um, Share my screen. Okay. So first things first is here's our agenda. We're gonna do the community agreement and grounding, introduction to Nicole. Her presentation is decoding capital, what investors look for, and what founders should ask. And then Q&A session. But I think what we're going to do is she's going to have Q&A throughout her presentation, and then we'll go through sharing resources with the gratitude and closing. So here's our community agreement. This is something that Native Women Lead has put together in terms of all the work that they've been doing over the years. Native Women Lead is committed to the understanding of the inherent value of the women in our community to learn and celebrate mistakes. We are committed to radical transparency, understanding that we will work to heal each other and our communities in the decisions we make. We believe in thinking critically about our work and its impact on the earth, on Mother Earth, and our peoples. We strive towards greater inclusions of our relatives who possess different abilities and come from different backgrounds. We believe that our work must be intentional and utilize anti-racist frameworks to ensure we keep moving forward with social and economic justice in mind. So with that, I'm going to hand this over to our interim executive director so she can do the introductions.
Thank you, Irvina, and thank you, Nicole. We appreciate the time that you've taken to share with us your knowledge and your points and advice as well as opportunities with our business community. Nicole Johnny's resume speaks for itself. You all have seen her bio, and so I'd like you to know that, as we build out our community, the individuals that come before you and present are a part of your community and a part of your resources and your network. Reach out and make the connections and see how you can build and grow in areas that you or your business need. So, without further ado, I would like to turn over the presentation and the training to Miss Nicole Johnny, and we will all be taking notes and appreciate your time. Thank you, everybody.
Thank you for that. I'm super excited to be here this morning and to share a little bit more about some insight that folks might have when talking to investors and getting maybe a better understanding of what's behind the investor perspective. But before we really get going on that, just out of relationship and kinship there. So Nanayat A, I've been sé Nicole Johnny Nishia, Kia Ani Nishle, Dod Sitna Jene Bashishin, Trabahe da Shiche Ado, Nasha Dina Ed Ashanale, Akut Ego Dina Astana Nishle, Do Trons Ele De Nasha, Reya Beedil Lesinil Esharan Ado Shananishte. So, I'm a member of the Navajo Nation. I grew up on the nation where my family decided to tie me to Mother Earth is in the community of Crystal, New Mexico, located about 50 minutes north of Gallup, New Mexico. I'm born to the Towering House clan, born for the Blackstreak Wood people. My maternal grandfather's lineage is the Water's Edge clan, and my paternal grandfather's lineage is the Tewa Bear people. That's who I am. So if there's any relatives in the room, hello. I'm glad that we could establish some kinship. And if not, we're already building a sisterhood and relationships here. So super excited about it. And again, I'm just really excited to spend some time um, sharing a little bit more about capital and what does that mean, especially when you think about equity investments. Um, my background is has been in finance for the past like 12 years. I have an MBA in finance and undergraduate degree in finance and economics. Um, I've had the wonderful opportunity to work at different venture funds and now on my own, launching my own investment fund called First Sovereign Capital, of where we are a Native founded and Native woman led venture fund, um, really looking to back and invest in Native entrepreneurs across the US. And, I think it's really part of that efforts of why capital is needed to grow our businesses and how can we make it more accessible. But before we even make it accessible, how do we even interact with this? And so these are, some of the information and that you'll see in today's presentation is a lot of what I've learned over the past few years, whether it's been from a perspective of tribal portfolio management, of still running investments that way, of venture capital investments as well too. So just wanted to share a little bit more of where these are things I've commonly seen when I've worked with founders or worked with folks really interested and kind of curious about how capital kind of can work for your company. And if you have any questions like throughout the presentation, please feel free to ask them. It's all a learning environment. You don't know what you don't know, but if there's something that's a little fuzzy or you want to lean in a little bit more, please do so. And so, why we're talking about this is that a lot of founders are told to raise capital. Usually, it's the next step in the process of growing your business. But when someone says raising capital, like what exactly does that mean? Where do you go? With loans and grants, we know there's an application process, right? We know that there's like qualifications. But when we say raising capital, what exactly does that mean? And really, it really shows that, few founders are really shown what investors are thinking, how to approach investors, or really simply, what does that mean to how to even enter this conversation? Irvina. Oh, you're on mute.
I don't think your presentation is showing. I don't see it.
Oh, on my end it is. It's green on my end.
I can see it. Does that say why are we talking about this?
Yeah, why we're talking about
Okay.
this.
Okay, I see it as well. Okay.
Okay, good. I see it now.
Okay. And really here, I'm going to drop the first question into the chat. And it's really just to kind of, I think, build a little bit more of a conversational piece here. Um, let's see, is really, how familiar are you with raising investment capital? Is it A, B, C, or D? If you could drop that in the chat, that'd be great. Because really, again, today's conversation is about how investors, um, evaluate businesses, what types of capital exist, how founders can approach these conversations, and really go about what does this mean. Okay, so it looks like we're a little bit on exploring it, and that's totally fine too, because we all got to start somewhere. But here's kind of the reality. Capital conversations can feel intimidating. A lot of the times with funding, there's a little bit of a balanced structure in place of where someone who has money and it's up to them to allocate it to say yes or no. You can kind of feel that power dynamic there as well too. Sometimes it feels like you can be entering a room of where you feel like everyone knows what's happening except for you. Sometimes investors use languages or words that sound like a different language, like valuation, cap tables, dilution, Series A, pre-seed, pre-revenue rounds, all of these different things. And, even things of like, okay, well, do you have a term sheet? Like, what's your pitch deck? How do you anticipate in, making a return back? Like, what's your exit strategy? Like, all of these different things can feel so new. And it feels like, what are they actually saying? And so, but really, it's about, understanding your business and its potential. But sometimes specific words that are using is a little bit on a language of its own. So when you're kind of working through this, you might actually ask what are investors actually looking for. Um, Essentially, the things that investors are really just trying to understand the problem that you're trying to solve, the opportunity and how you're trying to solve it, and then wanting to know who you are in building the company. And so once you kind of understand at least those three main building blocks, they can become a little bit easier to navigate. And, there's definitely some great resources out there, and that kind of breaks down a little bit of venture capital terms or terminology. So those are really great to kind of maybe learn into or lean into a little bit more. And so you don't feel so lost when different language is being used around you. And so, kind of like, we kind of got ahead of it today of how familiar are you with raising investment capital. We learned that some folks are just learning about it and that they heard about it. Do you guys know of anyone who's raised capital before?
You.
And I guess to kind of back up to for Sovereign Capital, we're raising our inaugural fund of 10 to 15 million. We've got about um, almost a third committed to the fund, and so that's kind of where we're at right now. And I have, raised a little bit of working capital towards the operations of the company. So yes, it definitely um, can be a little overwhelming. And how do you go about it? How do you find the right partners? How do you even find people with the pockets to even do this stuff? And where do you even start with it, And so that's also why, too, I think it's a great opportunity just to spend some time talking about what does it mean? What does that look like? How did you start? How did you start raising capital? And how did you know it was the right fit for you? Um, but before that, really understanding investors of what they're looking for. They're really looking for things that go around trying to answer some core questions. And the core questions is what is the problem, and how is your company trying to solve it? Ultimately, that's one of the first things because investors want to see that your business is addressing a very real problem and need that people care about. So, like, the stronger, the clearer the problem is, the easier it is for you to show why your company, the product that you're building, or the solution that you're presenting solves this problem. And that itself is just, not enough. We see a bunch of problems around us and we have all great ideas of how we can solve them, but the next thing is kind of like, it's a real market opportunity. We're investors looking at, are there enough customers to support and grow this business? We really want to understand how big the market is, how much the company can grow, and how really, businesses reach them. Part of this is going to be kind of layered in your GDM. Like people are like, what's GTM? It's like acronym soup, but it's like your go-to-market strategy. So really, how are you building the company? So one, what is your problem? Like, what are you trying to solve? And then really, how are you solving it through your business? And what's the strategy and like the benchmark milestones that you're going to meet in order to start solving the problem there? And so you really have to frame it up in that manner. And the next question that a lot of investors look at is you. Are you guys the founder? Is this the person and the team to build the company? If you're a solo founder, what part of the business do you carry? Are you going to be bringing on a co-founder that might complement your skills that you might not have? And this is especially important if you're going to be a business that's really in tech or maybe healthcare or something that has a very special niche to it because you want someone that on your team who really has that deep technical expertise. And if it's not you, who is it going to be and how are you going to do it? So a lot of venture capital investors are really looking at, are you and your co-founder the right mix to get it to build this thing and to get it going? And then also to, what does your team look like? Do you have an advisory board? Do you not have an advisory board? Are you looking to establish one? When are you going to have employees? When do you think you'll be able to bring on employees? Because a lot of the times they say that investors are looking to invest in people first. They really look at, what do you bring to the table? Is there the conviction that you have in this is the right founder fit for the company? And then again, can the business grow? Investors are evaluating whether businesses can scale over time, meaning revenue, customers, or impact can grow beyond the founder alone, And these are really the questions that investors are looking for and they're looking to answer, when you first have an introduction to them. And honestly, a lot of venture funds, they want to respect founder time. So sometimes you only get like 30 minutes with it as an intro call with someone on a venture team. And it's really having your deck on hand and really saying, here's the problem statement, here's our solution, here's the strategy of how we're going to get there, plus our benchmarks. Here's the opportunity of why, we're going after this market space. And here's how much we're looking to raise, and here's how we're going to use it, and here's who we are. Literally your pitch deck should be from like 8 to no more 15 slides at max, 8 to 10, 10 to 12. 8 to 12 is a pretty good sweet spot to kind of like fall into that space there as well to kind of get the point across because they're not looking for an in-depth business plan or analysis. They're really looking at these core questions. And so it can be a little bit different if you're going after venture capital versus grants versus like loans of where there might be numerous documentation, but usually an initial conversation with a fund really revolves around a deck and 30 minutes with the team there. And sometimes too, what happens when you think about investors, there's a little bit of maybe myths around what is believed to happen in the market space versus how conversations actually work. One of them is that only numbers matter, um, while that while that can feel really true when you're talking about growth potential and return on the investment that your investor might make with you. Really, though, investors do care about the founder and the problem and really the opportunity. So, financials do matter, but really the story, the vision behind the business matters just as much. And those are from investors who really are looking to back businesses that are in a line like with their investment thesis and with what they want to, how they see their money being used. Um, Another myth you might have heard is that every business should raise venture capital. The reality is that not every business is a fit for an equity investment. A lot of businesses have grown successfully through grants, through, by their own revenue growth, loans, and maybe other forms of capital. And I guess to get a sense of it, are the businesses that you guys part of, has there been any type of like grant or loans taken out? Or has it all just been growth on its own or natural growth through revenue?
Mine has been on my side has been through contracts, like getting contracts on the side. So I guess what would that be considered? Like
Yes,
growth revenue?
yeah, you're growing revenue, you're growing the business through its own revenues. It's kind of like self-funding, paying the company kind of pays for itself to grow. And Willow, the question was, how have your businesses kind of grown from now? Has it been through maybe some loans or grants? Has it been purely like bootstrapped and just been like growing the revenue through just increased customer base? Growth revenue. That's cool. That's good to know. And that's good to know that businesses have been successful in that manner as well too. Um, And thank you, Sharissa. So, what I always like to think about when I think about venture capital and equity-like investments, equity-like investments is you want to look at the different types of capital and how fast they can get you from points A, B, C, or D. And so, loans might get you, might get you a little bit there faster. Um, Grants might get you there a little bit faster, but when you self-fund it and it's bootstrapped and you're growing customer base, depending on the sector and kind of like the growth expansion that you're feeling, it could be pretty slow or it could be really explosive, and really equity like investments is really kind of the capital that really like launches you into the next area of growth because you're just ready to keep going and keep growing and keep doing it, keep, building the business. Another myth that I think I've also heard is that investors hold all the power. I'd like to think that investments are a partnership. Founders should also evaluate whether an investor is a right fit for their company and values. And so when you meet with investors, it's not only what are you doing so they can determine if you're a fit for them, but what do they bring to you as well as an investor in your company? Do they understand what you're doing, why you're doing it, and does this mean how important is it are certain things to you in this business, and will they be able to understand, the growth rate that you're at? And maybe another myth that you may or may not have heard is that you and your ideas need to be perfect before talking to investors. Um, that's not really the case. Often it's investor relationships, begin early, often before a company is fully built. Especially with pre-seed, pre-revenue. So like pre-revenue companies that are kind of getting their footing on the ground and they haven't quite launched into a product just yet. Yeah, at that point, some founders are going out and soft pitching what they're building with investors because if it's not a fit for an investor at the time, most often they're going to say, like, okay, well, in 6 to 8 months, 8 to 10 months, like let's circle back and see where you're at because, maybe by then you have gotten the prototype out. Maybe by then the business is a little bit more shapen up at that point. And so that's why I think it's great to kind of, talk with investors, beforehand, so you start understanding what they're looking for, what their needs are, or like what type of investments that they make, and determine like is that a fit for you and your business and where you're kind of going at. And so, and here's my favorite lovely slide around types of capital. We've all heard of, um, the grants and the loans and the pitch competitions and technical assistance. And, we've all kind of like been working in that manner. I feel like not so, those are not so scary. There's been a lot of conversations about it. We see a lot of work in our communities around these types of funding. And so, but capital evolves as your business grows. Not every business is going to get a huge cash infusion at the beginning, but there are some. But, typically it's starting small, building credibility, and then building towards larger pools of funding. And so, every source does have its place along the business cycle, whether, it's like grants and microloan support, equity, partnerships. And so every type of capital can really work. And so, if you're really at the idea stage of a business, it's definitely working towards like the grants and maybe some pitch competitions. Because I think pitch competitions, they sometimes have, what is it, awards anywhere from like 1,000 to maybe $10,000. I think I've seen for pitch competitions. And so, and those are just kind of some programs around that to support early ideas or ideas of a business starting. And then you might kind of grow into a side business where there's some micro loans, smaller types of loans that might help you kind of acquire some assets. Maybe like desk space, maybe things that kind of help your business grow a little bit more. And so those could be like CDFIs, those could be kind of like your traditional community banks in that manner of the microloans and kind of providing the technical assistance. And then as you kind of go through the early stage growth, that's kind of where you see maybe things about like revenue-based financing or angel investments. And so now we're starting to see a little bit more of the equity component. Again, that like faster capital, because really grants and the microloans are kind of like that slow and steady type of capital that like gets you going. And then once you're kind of like got a good pace, then maybe you make the decision that you're ready to start like running full speed ahead. And to run full speed ahead, you need capital that's a little bit faster. And so that is where you kind of start getting those equity or equity-like positions for your company. And so that's why you have revenue-based financing, which is really kind of when you think about royalties, percentage of your revenue goes, back to maybe your investor of however you negotiate that. So you don't give up ownership of your company, but rather it's kind of pledging revenues for in exchange for the capital that you're getting. You might also consider angel investments as well too. At First Sovereign Capital, we're activating the First Seed Investor Network, and so it's an angel investment network to really support Native entrepreneurs who are interested in raising maybe rounds, less than $100,000 in angel funding, to really kind of build that together. And then as you go from the early stage to more established businesses, you might start looking at larger bank loans. So like commercial banking, like equity, joint ventures, those can be from like the well-known institutions, like SBA, if that's a route that you go down. It might be around impact investors. It might be venture funds. You might find joint ventures with tribal enterprises or entities to kind of really grow that capital, grow the business with the capital that you need right there. So every stage does kind of have a good fit of capital depending on where you find yourself at right now. And usually the difficult part is like, how do you kind of like find the network? How do you even get into asking for or applying or getting into the loop of talking to investors? And so that's really kind of like what I like to do, is to kind of work with founders and getting them kind of plugged into maybe capital that works of where they're at in their business. Because again, venture capital is not for everyone, but it's a really great option to have. Here's an example of that. So if you're a business that's really looking to buy a lot of like machinery for like printing or like farming or buildings, so like desks and things like that, those are the assets for a business. That's really not a fit for venture capital. Like if you're an asset heavy business, probably venture capital is not going to be the greatest fit, because it also can be a really expensive form of capital. So you're probably going to find more friendly terms of capital when you're looking at things for like asset-based financing. So like loans are literally probably the best fit for things like that. But again, if you're looking to grow quickly, your margins are really healthy and you're kind of like, okay, we want to take the next step and just kind of like launch and keep going forward. That's kind of where, equity positions kind of come in as well too. Just wanted to kind of maybe share a little bit about that. Any questions? And so kind of harping a little bit about this of when capital makes sense. And so this kind of like fleshes this out a little bit more. So early stage startups, those are well suited for grants, microloans, early support programs, because really at that early stage point, founders are often testing an idea, building a proof of concept, validating their market's opportunity of what they're building. And then when you get to kind of like the scaling stage, those are businesses that have strong traction, they have proven demand, they might pursue larger venture capital sources, venture capital, private equity, large debt financing, because that's really supporting rapid growth, market expansion, and larger operational scale of businesses. And so again, that's the scaling stage. Like you're not looking to buy more hard assets. You're looking to say like, hey, I'm going to raise, I don't know, I'm going to raise $1.2 million because I need to hire these positions because these positions will get me to this benchmark of, this revenue of this growth. And here's why I need it now versus like going down, some debt rabbit holes as well too. Growth stages then are now beginning to generate like stronger revenues and traction. So those are maybe like bank financing, angel investor, strategic partnerships. This is really to really get everything expanded and growing customer base. I know scaling and growth can kind of sound a little bit similar. And sometimes they are, again, it just depends on like what your business is built and what you're planning on doing like with your business as well. So it definitely is kind of, really wanting to spend some time understanding where you're at and what you want to do. A lot of the times, when you are thinking about equity like investments, um, typically you might be making the change from an LLC to an S corp because most venture funds are not going to do investments into LLCs. So you're going to have to, if this is a route you really want to go down, you're going to have to look to make that conversion.
Nicole, for like, so when you say angel investors, is that so people who like what you're working on? And so when you're investing in a company, you're not expecting anything in return?
So
Or is that the negotiation piece that happens with you, like the business and the investor? Like what are most investors wanting something in return?
Yes. So with angel investors, they're looking to provide that early capital that you need, because the anticipation is that when you get to the next round of investments, they might be able to kind of get a little bit of the return back then, or they're going to continue staying on with you in hopes that the company continues to grow. So at some point, the company will exit or it will recoup its investment over some manner, and that's I think why it makes a lot of sense to spend some time thinking about what you're building, how you're going to pay it back, maybe because I've seen where you can do it of doing kind of like revenue-based financing in angel rounds, but that's if you're already proving strong revenue. So you might say, hey, in exchange for, and this is what you see a lot on like Shark Tank, if you spend your Friday nights watching Shark Tank, a lot of the deals that you see when they say like, okay, what about 20% equity and, royalties of 1.2% or 2% of royalties, like those are kind of like revenue-based financing of where they're getting revenues off of like they're getting royalties off of the revenue to help pay back what they invested into the company. So you can kind of structure that with angel investors if that's the route you want to go down. If you're trying to preserve, and usually when you're doing revenue-based financing, it's because you're trying to preserve ownership in the company and you're not wanting to give it up so soon. If you're planning on doing maybe like a Series A round. And Willa has a really great question too about what role does funding play in supporting service-based organizations besides loans? That one is really hard because service-based organizations and service-based kind of businesses that are, a lot of the times like consulting work, that's really hard to have an equity component because how quickly can you scale it? Like what are you trying to solve with the consultant businesses? Because a lot of the times like the consultant side is like, this it could be based on like reputation or character or skill set, but what does that mean to kind of like grow that team, to kind of get you to the next level there. So sometimes again, equity is not necessarily the best fit for for service-based organizations. A lot of venture funds are going to say no if it's a consultant business, unfortunately, just because of that scaling and growth component. And so, and we talk about like founders should evaluate investors as well too. because, investments are more than funding. It's a long-term partnership because when you're taking on investors, it's not just a loan that you're going to pay back in 3 to 5 years. It's the long game here, and you really want to understand like things about like, do they understand your vision? A good investor, a good partner should understand the problem you're solving, the community that you're serving. And if they don't see value in that mission, the partnership, might not work. Going back to like, are your values aligned? You know, Investors bring expectations around growth, timelines, decision making. Um, and as founders, you should really consider those expectations and whether they align with like your goals of what you see yourself doing for your business. And then also too, what else do they offer besides capital? Like a check is great to have, and a check is great to cash when it hits your account. But, a good investor doesn't just offer capital. They offer mentorship, network, strategic guidance, and not just money. And so, when you meet with investors, take a look at their portfolio, see who they've invested in, and when you do have a moment to talk with investors, ask them like, beyond writing me a check in this investment, what other opportunities to support my business can you provide? And then also too, I think another important one is asking potential investors, what does success look like to them? You know, um, Definitely understanding how they define success will help you understand if this partnership will support the long-term vision for the businesses. Um, what would you consider baseline revenue are investors looking for ROI? That's a great question, Deborah. It really depends on what type of sector that you're in. If you're in consumer products goods, and if you're going traditional venture, they're probably going to be looking for a minimum between $2 and $3 million in revenue before they're going to consider an investment because the competitive nature of consumer products and goods. And so that's what they're going to be looking for before you might even qualify then. And in terms of ROI, it depends as well too. Are you going traditional venture or are you going to be going towards impact investors? Impact investors will sometimes not drive revenue as hard as traditional venture. So impact investors might take a little bit of an ROI that might be less than traditional VC, just because they know that impact is also one of their metrics that they're looking for in their investments as well too. There's certain things like that, and also too, what type of investors are you going to? Because if you're a pre-seed, pre-revenue business building in a tech-based company, you're definitely not talking to the funds that participate in Series A, so like over $20 million rounds, like 10, 15, $20 million rounds. So that's probably not where you're probably not going to want to talk to them. You're probably going to want to talk to investors that do pre-seed, pre-revenue because they're going to be writing the checks that maybe are rounds between, I don't know, 2 to 5 million. They might be like in that range of supporting rounds like that because they're not just going to provide checks. They're going to provide you like the network and the support to continue building this business as you go along as well too. So again, it depends on sector. It depends on what stage that you're at. It depends on who exactly are your investors that you're looking to kind of bring along, which is why it's so important, so important that you need to also evaluate your investors as well too. And if you do, have a conversation with them, instead of asking them, tell me about your portfolio, usually the who they've invested in will already be on their website. So you don't need to ask them that question, but rather a better question to ask is how would you support a business like mine to get to the next level? And and is that next level what you would consider a success? That's a more meaningful question to get out of an investor than tell me who you've invested in because you can read that on their website. How would integrating a community-based service arm separate from consulting impact funding or investment potential? I think with that community-based service arm, it's really going to be on your end of how you want to kind of build that out. I know a lot of folks are kind of doing this for-profit, nonprofit hybrid model, and that's great. But that if it's going to be a hybrid nonprofit for profit entity, the investors are probably not going to want to have anything to do with a nonprofit because they want to know that their money is building the business. And so, um, and so on that end, but let's just say you have to be kind of creative around it. So let's just say that you might consider building out a community service hours in your model, because um, maybe that supports your customer base. Maybe you're saying, here's the problem, here's how I'm solving the problem. But in order to build more of a customer base, we're gonna give our serve up to X amount of hours, pro bono at discount or whatever, because you're also growing your customer base by doing that. So in a way, it's kind of like a two-in-one of where you're growing customer base and then you're still having like community um like impact as well too. You just have to, I think, maybe really see it through and be a little creative in how you want to complement that, like with your businesses. What I've seen in terms of like kind of like hybrid models are have been when I say hybrid models, I mean businesses that are kind of that lean both on like the impact and commercial good, tend like usually work in terms of like maybe there's community service hours that are built in with employees that give X amount of hours back. Maybe there's a scholarship component. Maybe there's like intern opportunities for a business as well too. So you're trying to hit two-in-one without really impacting revenue and growth. Yeah, those are great questions, Willow. I really do like them. Um, And so, we talked about a little bit about what you should ask, what you should, how you should start evaluating kind of a partnership with an investor. Um, but what are signs of an aligned investor relationship? Like when does it work well? You know, on my end, taking on investors in my company, I've been really clear from the get-go of like, this is for Native community, this is going to be a long-term thing. Like, understand that an ROI is not going to be immediate. It's not going to be in like 3 to 5 years. We're going to take the long route because in Indigenous community, here's what we see and here's the solution to the problem. Are you okay with waiting that long? Because if you want a quick ROI of your money, I'm not your girl. My company's not that fit, and I'm really honest from the get-go. Like, and I say, like, I'm looking for partners that want to stand with me, and I'm looking with partners who understand the vision and the values that I hold at my fund, and that we want to empower community and we want to use capital in service of community rather the other way around. And so that might have scared a few folks off, but on my end, it's that part of like this is what a value aligned investor will see and value of what I'm building. And so and as you get comfortable talking to investors, you'll start learning what are the things that are you have leeway in terms of like um room for negotiating versus what are the things you're like absolutely not, of like I'm not going to be able to post a return in 3 to 5 years if that's what you're looking for, you know, uh, can't guarantee that. You might have to go knock on a different door, but those are the things that you'll start learning as you figure out how as your business works. But I think with that comes the line of transparency. Aligned investors are open about their expectations, their timelines, and investment terms. Um, you understand how decisions are made and what success looks like. You're in agreement on what that looks like. What does communication look like, between you and your investors? There was respect for the founder leadership. They trust, what you're building, your expertise, then rather than trying to control you and every decision that you make. They really see themselves as partners in supporting what you're building. For me, that's really, really important that they're on my team and that they're not trying to um, break apart what I'm trying to build. And so that's for me is really important as well too. And I think especially as Native women, it's important to find those who respect kind of like the expertise that we carry. Um, and what we see for the businesses as well. I also think it's a long-term perspective, just understanding that building a strong, resilient business takes time, but that it's not just drawn out, but that there are agreeable like milestones, that these are the agreements of where we're going to be at and how we're getting there. Going kind of back to your initial pitch deck of like, here's where we're at, here's where we were planning on going. It requires like, how are you accountable to your investors? How are you transparent around them? How do you choose to communicate with them? For me, it's through quarterly updates of where I keep them. I send out, and every quarter I send an update to my investors of here's what we've accomplished in this quarter. Here's what we're going to do the next quarter, because come, quarter three, quarter four, we want to be here. And so it's clearly, being transparent about what we've done and saying things of like, here's where we've struggled. If you can provide some support from your networks in these areas, I'd greatly appreciate that. And it's also just kind of saying, and here's where we've succeeded and done really well, because now that we've done this well, we plan like this is going to go well for the next few months of X, Y, and Z things. I think that really comes down to, again, that transparency, that respect for the long-term perspective that you're carrying, and really that accountability from both investor and founder. Then I also think there's a cultural understanding, especially if capital is coming from non-native investors as well, that you might bring on your cap table, is really that cultural understanding and respecting that, that your business does serve maybe a certain customer base. And the customer base might be a little bit different from if it were, not a not a not a business that's very niche in an area. For me, it's about telling my investors this is to support Native entrepreneurs. Like, we're not just supporting everyone and anyone, we're supporting Native entrepreneurs. Specifically, we're supporting Native entrepreneurs in consumer products and goods, and food systems, in tech. Like, these are the three areas that we're going to make investments in, and here's how we're going to support them. Of being really like specific about those, and so that and it's like, and these are some of the plays that are going to be a long-term play, and understanding and telling investors, and are you okay with that? Because here's also our impact and our return that we plan on having. Um, and again, just kind of that little like cultural understanding as well too, of how decisions are made. Maybe you might want to have community investment committees. Maybe you have a community liaison on your team, and how is their voice part of kind of like what you're architecting, and do they understand if that's a cultural thing that you're building into the company? Do they understand that? Do they respect that process as well too? And I think what's also important as well is also kind of having a little bit of a reflection for yourselves after you talk to investors, is like, did you feel respected in this conversation? Do you feel like they actually heard you? Um, you know, do you think they understand the mission behind my business? And thinking about it too, like, do I want this person as a long-term partner? And because those are some of the things that I've had as well too, to talk. There's been I've gone into some conversations with investors or partners of where I felt like they didn't respect my perspective of what I was carrying. Um, I didn't feel like I felt like they dismissed me because I was so young, and they thought I didn't have any expertise in what I was doing. And because of that, I stepped out of those conversations, and I said, you know what, like, thank you for your time. I sent a follow-up email, like, thank you for your time. It was so great to have this conversation with you. Right now, I currently feel like we might have missed the mark on a few areas of alignment, but if there's anything that I can do, if there's anything that you'd like to know more of, I'd be open to it. Or sometimes you don't even, if you don't want to, you don't have to include that line. And sometimes you can say things about like, I felt like we missed each other on a few points. And at this point, I don't think it's a strong fit for me right now. And it's okay to assert those boundaries. If you really don't feel like it's a fit and you just want to move on, because I think it's just kind of, it shows maturity. It shows the experience side of like, hey, I see it's not a fit. You see it's not a fit. We're just going to close the loop on this. And so if someone ever asks them about you, they're going to say like, yeah, like they were really professional, and we just realized it wasn't a value aligned fit, rather than saying like, oh, I don't know, it was the business, because then you leave them speculating as to why it never really worked out. And so you leave a really great impression, even if you kind of close the loop on that. And then again, just, do they understand the mission? Do they want to stand on your team? Do they want to be your cheer squad for you, because really if you're going to go into the equity thing, you're literally selling shares of your company. You're selling ownership of your company, and it's kind of like I don't want to sell my company to people who don't support me or don't see my vision or don't want to stand with me in this vision. Um, because when you have a team that's not fully in supportive of what you're doing and how you're doing it, it can easily become a difficult uphill battle because you're like, great, I have to work with them. Like they own my company. How am I supposed to navigate this? And so really, I think it's a great moment for reflection for founders in that manner. And again, it all kind of points to, do I really want this person as a long-term partner in my business? And so kind of like here's a question here. So, you know, um, if you've not had an opportunity to talk to an investor, or if you have, or even from just base of this conversation, what part of investor conversations feel the most confusing? Is it just, what are they looking for? What does that mean? Like, how do I even prepare for this? What types of capital do I even pursue, or investor fit? Or is it just really like, maybe I don't really know where to start, and that's okay too. And so this is kind of it. Maybe take some time and read through each bit and just maybe share it out loud, drop it in the chat box of kind of like what feels the most confusing right now.
Nicole, can you talk a little bit more about why founders struggle with deciding between grants, loans, equity investments, the revenue-based financing, and then other funding pathways?
Yeah, I think um it gets confusing. Like, where do you even start? Like, which one do you start with, and how do you go from it? And how do I even know where to even find these things? Um, for what I often like to share with founders is, let's take a look at, everyone has a business plan. If they don't have a business plan, they have a pitch deck. They have something that kind of guides them. And I always like to ask founders, okay, okay, what is it that you're doing? Is it a grant alignment? Is it a loan requirement that we're looking at? Because again, it's really like based on your business, like where you are at in the business cycle. How many customers do you have? How many customers do you not have? Do you have an area that maybe could be supplemented by grants? Maybe you need a supplemental or supplement by grants for like the interim as you're kind of exploring something. So if it's like tech, I know they call them SBIR grants to kind of really support kind of the research, R&D, kind of techie type of investments as well too. Those are like R&D type of grants. Those are SBIRs. Um, and then I know there's the tribal registry that does a lot of grants, but those often require being a 501(c)(3) or a fiscal sponsor. So that's, sometimes a little bit of a hurdle. So, I think it also again goes back to, what are you building? How does it all kind of like, how does that whole thing kind of come together? Like, is it services based? Is it a product based business? Is it like, what exactly is it? And then you can kind of start shaping and finding your way through it. Because with grants, I've had founders tell me, I don't want to go for grants because I'm not a for-profit, and I don't want to do like grant reporting. you know I've had feedback like that, and that's why some founders are like, that's why I'm not doing grants whatsoever. And then there's some who will try to go straight into the loan area as well too, and that's when I'm like, okay, that's great. If you have things to collateralize, you can have maybe a loan on top of the business. However, it's really getting comfortable around like the debt service, like how are you going to pay it back, like what does that look like. And so I think really it comes into, what are you building, how are you building it? And um, and what feels like aligned for yourself. Maybe it means bootstrapping it. It means kind of getting into the nitty-gritties. Like what do your financials look like? Because are you looking for funding that's $500,000, or are you looking for funding that's maybe $10,000, or maybe it's $5,000, And what is that point of when as entrepreneurs you kind of like take that launch full time? What does that look like at that crossroad? And so I think it really is. That's why it's the biggest struggle because you're not sure really what to go. How do you blend it all together? But really, when you do take the time to understand what drives your revenue in your business, you're like, okay, what drives the revenue? What am I doing? How am I solving this problem? How am I going to get there? What does that mean to be profitable in this next year's? Like, what is the best case scenario? What's the worst case scenario? And what's base case scenario for myself? And I always like to kind of pose that to founders. What is best, base, and worst? Because then you can start thinking, okay, maybe I need to supplement my growth with a loan right now. So then I'm looking for like money for this amount of dollars. I know I'm bringing in this amount of revenue for these months, and I know I can cover debt for this amount for this long. And so it really does take just really spending some time on financials, on your growth plan, where you're at, and understanding kind of like how does that money get you to that next milestone? Because I think what happens often is that you build the business, you're going, and then you realize that like payroll, you realize you got bills to pay the business, and then you start like freaking out because there's no money to pay it because your customer base isn't coming in because maybe the product isn't fully built out because of X, Y, and Z. And that's also why too, when you start kind of going down these routes, it gets a little bit like investors can sense when you're really like on edge as well too. Like if you're at your last, like this is your Hail Mary, investors will sense that it's your Hail Mary. And so that's why it's kind of best to get ahead of it beforehand and really spending the time looking at the financials, really looking at like, okay, here's my runway. If I didn't bring in new customers right now, how much money in the bank do I have and how far will that get me? Because then you'll say, okay, I got to pull back on expenses. I got to pull back here because I gotta like maybe drive more customer revenue here, here, and here. That's when you'll get really strategic when you kind of start looking at where you're at and how do you drive that revenue and what makes sense? So not the best answer, but it is, I think, a very like comprehensive overlook because it really is about where you're at, what you're doing, how you plan to get there, how much money do you have. If you're a Hail Mary, oh yeah, you're probably going to want to do the grant because or not grant, a loan because you know that those can be issued out within this certain time frame and you know that cliff is like right there. And if you have the revenue to cover that. But if you think that you have runway as much money as you can. You have runway until maybe next year. You might maybe want to start exploring grants. Maybe you want to start figuring out what do venture funds like want to invest in and asking them like how long does it take it from initial call to closing on an investment so that you know where the timelines are teaming up of where your runway is at.
Nicole, what would you think of like crowdsource funding? Would that be kind of off of like revenue-based financing? Would that be kind of like
Yeah.
Kickstarter or just saw a presentation recently where they talked about campaigning on Kickstarter as a way to kind of, so I was just wondering where that kind of fits in, like in different strategies of capital, pursuing capital.
Yeah. Um, Kickstarters are really kind of like I think of them parallel to kind of like angel investing. It's a really nice way of it's really like community-based capital. It's depending on what exactly they're doing, they can pre-sell a product, before really kind of going into it. And I think it's kind of a really cool, you might be able to pre-sell a product or idea. I've seen them used best for kind of like consumer products, or founders with a strong community, audience or yeah, strong community and audience. Um, and in really testing demand for a product, before launching. And so I really do think it's like it's great because there's no equity given up. It's great because it builds community and early customers. It could validate your demand of what you have. But the thing is, though, is that the campaigns do take time. Like, what are the actual things that happen behind the scenes? Like, if it's a product, like, is there a minimum order? What happens if you don't meet that minimum order? It means strong marketing, strong storytelling, and like you have to deliver on that product that you're pre-selling, you know? And so I think it can work. I think I've seen them do some really cool do some really cool things as well too. And I think they can be really, really great. I think they can be really great when done well. But yeah, I kind of see it as like angel investing, kind of like that early stage angel investing. There's not really um, a finished product that's ready to go to market just yet. That's where I kind of see, that's where I kind of see that happening there. Um, and yeah, and so here are some key, I think, takeaways and thoughts that might summarize a little bit about today. What investors are really evaluating. They're looking at the problem that your business is solving, opportunity in the market, because they're looking at can this grow? What is their customer base? How are they going to reach their customers? They're looking at the founder and the team building the company. If you don't have a team behind you, it's a question of, okay, does it make sense to have an advisory board? I have an advisory board, um, and I have an advisory board and a few 1099 folks who support me along my journey as well too. And then is there the potential for growth over time? And I think those are really, really the things that investors are evaluating when you're going down the equity route, which is absolutely different from when you're looking at loans and grants. Grants are looking at outcomes. How far is this going to get you? Loans are like, can you pay it back? Like those are the general questions with equity. It's kind of like, what are you solving? What's the opportunity for growth? Can you get there? Are you the right team to get there? But I think despite like all of those questions that you do go through, just remember that not all capital is the same, that the right investor is a partner. And it's not only funding, they bring you more than that. They bring you a support network, they bring you resources to you as well too. Um, and that founders should also evaluate their investors as well and taking some time to get to know them because again, this is a long-term partnership. This is someone that you want to know will stand alongside you and cheer you on as well too. And that I think that capital should also align with your values and your goals. And so it's really, finding the type of capital that fits you and really gets you to where you want to build. And even if that means taking a step back and like doing an assessment of your business of where you're at, where you want to go, what's your customer base, just taking that extra time and like learning in a little bit more of where you're at. You might be able to find a new customer base. You might be able to pivot and find a new opportunity for what you're already serving. And without stepping back, though, you might have already like forgotten how to do that. And so I think just doing that, taking some time also can really help you as well too. And I know it's hard when you're like constantly building, constantly going to find that time to set aside and think about where you want to go, where you want to be. What does your customers look like now? Who could future customers look like? What is the market opportunity? Where might you be able to easily make a pivot to capture more market? Those are things that I think are important um, to also kind of think about as well too as you're building and maybe um as kind of like the uh an ending question is, how confident do you feel talking to investors about your business today? Everything from like, I'm not quite sure I'd share my business. Maybe it's still kind of like in your head. Maybe somewhat you can feel like you can generally answer have a general conversation. Maybe you're comfortable enough talking about a pitch, but you're not quite sure about the technical aspects. Or maybe you're just ready to freaking get in front of an investor and make that pitch and make that ask.
This is Irvina. I was going to say, I know for sure that I am not comfortable.
No, I mean I mean it's definitely one that's a little daunting, understanding too if it's a fit, understanding like can is what does that actually look like, and part of my outreach and part of what I love to do is work with founders who are very curious about it. And so I always love to kind of send out a pitch deck template from Carta of saying like here's generally if you want to be in the general VC impact investment space, you generally want to follow a pitch deck that looks like this. You definitely want to understand terms of like a convertible note, like revenue-based financing. You want to understand like what is a cap table? How much of your company do you want to sell for, how much money are you raising and how much money are you selling or how much of your company are you selling for that amount? And how are you going to use that money? How is that going to get you to that next level of growth? And even down to sometimes like the nitty gritty too as well too is like even before even um talking to investors, understanding that sometimes too, it's like, maybe you got to make that transition from an LLC to an S corp so that you can do it in that manner. But no, I think it's commendable. It's really incredible when you're able to kind of raise, equity like investments or equity investments itself, just because not a lot of people have done it in our community, but it's actually really, it's huge. Like a lot of people go and they pitch for money, and they go and they raise maybe pre-seed, pre-revenue rounds as well too. There's native companies that are stepping up and doing it. I have heard uh, of a native company who raised $6 million last year for their company that they started about 2 years ago. They did that. They did a successful raise last year. There's a few companies that are maybe raising around $2 million. So they're, around that range. I know there's a few companies that are looking to, take that leap of faith and really kind of go out and pitch to venture funds. I've spoken with native founders who've said that they've pitched their business, 60 times and got 60 no's. And honestly, like that, as disheartening as that feels, sometimes for founders, like, okay, well, I'm gonna take a break from pitching because obviously they're not saying yes, what am I missing? So kind of going back to like, okay, well, how am I going to grow the company? Is this the right fit? What can I do in the meantime? Maybe a loan in the interim will help me sustain of where I'm at until I can get to that point, and so not every pitch is always a yes, but that's not to make anyone feel bad. I think it's just definitely trying to understand what they're looking for. Is your business in alignment? Are you even going to the right investors? Because who knows if that those 60 pitches that maybe 58 of them were actually not the right fit for them. And people just said, "Oh, do you know so and so? Go make a pitch here, go make a pitch here, go make a pitch here," without doing the right due diligence of, is this the right fund? Is this the right investor for me? So. But um, I think it's possible. People are doing it. Native founders are building businesses. They're getting rounds raised and fulfilled, and it's really exciting to see. But yeah, thank you so much for spending a little bit of time with me today. I hope that you guys have learned a little bit more. And I guess I'll just open it for any remaining questions.
Thank you so much, Nicole. This was incredibly helpful and just so enlightening to hear and just your knowledge share and everything. Thank you so much for that. It's been very meaningful.
Thank you. I'm really excited again to share this with you guys. I think it's incredible, and I think the more you know, the more you're like, okay, I can do this. I can do this. And I think it's more of like how can you be ready to do it? How can you, maybe go about this? And yeah, I'm really excited about it. I'm glad that each of you are here and learning a little bit more.
Thank you. I do have a follow-up question for you. So, with the original question that I had just around service-based and community-based services, So I guess my follow-up question is, then do you typically see like sponsorships and partnerships are better, like a better fit than traditional funding just for a service-based for-profit business? I know it depends on the business and the service, but I'm just curious, like just as a follow-up to what I asked before, is sponsorships and partnerships kind of typically where that lands?
Yes, I think they can be I think they can work well as a strategic, like non-dilutive capital. When I mean non-dilutive, like not selling anything of your company, like
Right.
not giving up ownership. Um, I think you can do kind of like funding or in-kind support from organizations, brands, institutions.
Hmm.
um, Maybe kind of like in exchange for visibility, alignment, or collaboration. And I think those are really strong around areas like events, media, fashion, creative work, kind of like the creative industry, maybe around consumer brands. Is again, thinking about like brand sponsorships in that way, you know. I think it's businesses that have really strong storytellings and really strong audiences, and maybe those that have a really good really good like community-based initiatives. So kind of almost teetering on that nonprofit area, but not quite, you know?
Hmm. Okay, yeah, that's super helpful just to think through. I think kind of earlier when we were talking or when you were talking about it, I think I have just generally found it more challenging from a service-based perspective with funding. And you definitely mentioned that and kind of confirmed that for me, which was super helpful, especially when it comes to grants and things. I think there's just some specifics that are just different from the top, what I'm looking for or what's in alignment. So it's just helpful to kind of think through, where my business is today and maybe also just thinking through where can I kind of build toward in the future. So,
Right, right. And I think like kind of going back to maybe sponsorships and partnerships, I think that they can really support like launching products. I think we see that a lot with the rise of social media and TikTok influencers and stars. You see them like building these crazy huge followings, and then like the brand sponsorships usually start coming on, and then you start seeing them launch products. So that's what I mean. It kind of falls into that sphere. And I think that they can work well with like hosting events. You know, I think it can be about expanding visibility, about building brand credibility. That would really align a lot with like a brand strategy, and credibility.
thank you.
Mhm.
Thank you
I
all for joining us. Is there any other questions or comments?
I
Thank you
think.
for sharing this, Nicole.
Yeah, yeah. And one more note about kind of like the sponsorships and partnerships, Willow, and you might already be 10 steps ahead of this, but the hard thing about those is just kind of like identifying that clear value exchange. Like in exchange for
Yep.
these partnerships and these sponsorships, what does that look like? And I know I was hearing some metrics around kind of like influencer things um that currently like there's such a wide range of what is a deliverable for a price. And so no longer it's now followers, it's now how many views. So like really keeping those metrics, I think are like those metrics are changing. And so understanding what that exchange kind of looks like is the hardest part, I think, about it. And then of course too, just kind of nurturing that so it's not just a one-off, that it can maintain like a relationship. So you kind of are building that a little bit more into the revenue stream.
Awesome. Thank you.
Yeah, yeah, yeah. Um,
Thank you again, everyone. We're going to do a drawing for How Money Works for Women, Take Control or Lose It, a Stop Being a Sucker book. Um, Let me get the little spinner here ready to go. I put everyone in there. Hmm. Don't you just love Zoom?
I know, don't you just love it and how it all comes together.
All right, I think I got everyone in there. Here we go. For the first, I'm going to give out to Willow.
Oh, yay.
Put your mailing address in the chat, and then I will send this out to you.
Okay, perfect. Thank you.
Um, Deborah, you guys are the winners. Thank you all again for joining us and keep a lookout for our next Transformation Thursday. Again, there's a survey there if you guys could get that survey filled out and then we can so we can see how we're doing. It's to measure how things are going with these events that we have. So I appreciate it very much. Thank you.
Thanks so much, guys,
Thank you
or ladies.
all.
Thank you for all the great information.
Yeah.
Thank you.
Deborah and Willow, don't forget to put your mailing address in.
Perfect.
Oh,
I just sent it. I private chatted it. Did it get to
Okay.
you?
Let's see. Yes.
Okay.
I'll send mine now.
Okay,
Thank
thank
you.
you.
Thank you.
Awesome. Thanks again.
And then Nicole, are you going to share your information as well, just so that if we want to follow up or just stay connected with you?
Oh, yeah, absolutely. I will follow up and kind of sharing my contact information of how you can
Awesome.
find me or follow me. I'm on LinkedIn, Nicole Johnny. For Sovereign Capital is one ST. So first for Sovereign Capital as well too. We're really excited about it. We're hoping to time it so that we can make investments later this year.
I'm proud of you. Thank you.
Thanks.
Thank you, Deborah. Thank you again, Willow. You guys have a great rest of your day and see you guys again soon.
Thank you so much. And I appreciate the book as well. I'm excited to read it.
Yes, thank you.
Yeah, take care.
You
Be
too.
well.
Bye-bye.
Bye-bye.
Thank you.
Thank you.